Hey guys, welcome to the Texas Blockcast. We're here with second-time guest, J.K. Walker.
Yeah, thanks, Lee. Glad to be back.
Yeah, we're looking forward to the conversation, J.K. J.K. is the regional North Texas president of Third Coast Bank, as well as the managing director of innovation for the bank. And we've had one other conversation. Now we're following it up here because there is so much to follow up on.
Yeah, it's really amazing, isn't it?
A lot has happened even in the last couple of weeks.
Yeah, in just a few weeks, with a new, president, a new group in power, bringing a lot of new ideas and a totally different approach to some things we've worked on a long time.
That's right.
Yeah.
Let's start back maybe November, December 2024.
Okay.
You know, the administration has not yet changed out, but the election has happened.
Right.
And so people are thinking, oh, things are going to maybe change at the Fed, at the OCC, some of these bank regulators. What did you expect? How long did you think the change was going to take? What were you seeing from your vantage point in regards to crypto
that's a great
policy?
Great question, because, ships turn slowly around, and we feel like, the regulatory bodies are a big ship, and they have a lot of banks to keep up with and a lot of regulations that they're trying to administer. And, the activity that we saw, even a few years prior to this, when we had some of the surprises, they moved quickly back then to stop activity. But the process of turning the ship around to where it's going to be, a line of business that's embraced, that the regulatory bodies are comfortable with, is going to come down to, I think, from a timing standpoint, a little slower than we might want, in the industry to see happen. And, I think that's just part of, innovation moving more quickly than legislation. Mm-hmm. And I think that's an issue that we've dealt with, over the last 4 years that you and I have known each other, really.
That's right. So now if we move to January, we have the new administration come and make some changes, acting ahead of the OCC. You've got different thought processes going on. What is the first indication that you get that things are going to change more rapidly than you thought?
Well, I just think what the OCC came out with, last Friday, was a little bit surprising in terms of, I thought it was kind of a bold statement.
It was.
That they made.
It was very, clear. It wasn't. They weren't equivocating, because most of the time it's vague and gives them room to maneuver. But it was surprisingly clear.
And rescinded supervisory non-objection, which I think is, what every bank out there is seriously concerned with. And so, I think any bank
can you explain to the listeners supervisory non-objection, what kind of process that is and what that?
So basically that means, you go to your examining bodies and you explain to them the plan that you have, the intentions that you have with any particular new product or service that you're going to offer, and you get their feedback. And if they say they have no objection, then you can proceed, cautiously into that next step. But what you have to be aware of is that the regulatory environment we're in is being very scrupulous about the way they inspect what they expect. Let's put it that way. And so I think anybody that's been in the innovation space, anybody that has stepped out a little bit and tried to do some things that are innovative, have probably had an exam that made them kind of question how fast they move.
Or is it even worth it?
That's a great point. So, the supervisory non-objection is a good thing to have, but I think, from a banking standpoint and management standpoint, that you're going to want a little more well-defined, range of activity that's going to be allowed and how it's going to be managed.
Yeah. So correct me if I'm wrong, but now that has been removed, a bank doesn't necessarily have to get that supervisory non-objection letter from the OCC. They can do things that were within their risk management practices and within their scope of business related to crypto. It doesn't mean that they can do crazy things. You're not going to see a bank open up a DeFi exchange or like a DEX or something like that.
You wouldn't think so, right?
Nothing that's going to be outside, but it does allow for a normal scope of operations where you could custody stablecoin deposits, for example. Now, so there's three bank regulators, four if you count the state regulator, right? So you have the Fed, the OCC, and the FDIC.
Right.
And then you've got the state banking regulator as well.
Right.
The problem has never been with the state banking regulator, although we wish that they were a little bit more interested in the subject matter. They've not been, authoritarian.
Well, of course, Texas has been very
pro-business.
Yeah, pro-business.
Yeah. But what have we seen from the FDIC and the Fed? How in lockstep are they with the OCC? Do you think that some banks are going to think, okay, well, we need these other regulators, or at least two of the three, to give us a similar view?
And these other parties have come out and said, we are not, at that point, the same point at the OCC is right now.
Okay.
And so, you do still have supervisory non-objection requirements for anything that you're going to do. And I think
at the Fed or the FDIC? At the Fed, yeah.
And FDIC as well.
Yeah.
From my understanding. And so, what the OCC is telling you is okay, and what the Fed and the FDIC are maybe holding back on still is going to be underpinned by the fact that anything you do has to be well thought out, well planned, and you have to obviously have risk management in place. And I think anybody that is in the banking business right now is super cognizant of know your business, know your customer, and anti-money laundering, all of these things, BSA, international connections. Those are heightened on everybody's list of anything that has to do with the banking activities right now.
Yeah. Yeah, because, I think if the viewer could put yourself in the shoes of a banker, it doesn't make sense to risk heightened scrutiny or more man hours of work or more XYZ for a portion, an opportunity that could be a negligible, rounding error towards the bank's broader business.
And you make a great point, because the cost of compliance is probably one of the most significant cost in banking right now. And one of the ones that has gone up the most, you talk about inflation, that's where inflation's hitting banks.
Cost of compliance.
Yeah.
Yeah. So if your cost of compliance is going to be X and you can increase your deposits by Y, if Y is a small number, then X might be a larger cost.
Yeah. And you have a charter, and it's a very valuable asset. You're risking capital. You're risking the ongoing success of a bank. And most banks in this economy, in the growth economy, and particularly in the markets we serve, we've been very blessed, to have really good economies and nice growth and very good operating numbers. And so, to your point, again, it's going to be something that every bank management team is going to think about, from a critical standpoint of what kind of impact will it have and what is the benefit and risk reward of being involved.
That's right. Yeah, as in every business,
right?
Some people look at the banking industry as sort of a utility, but it's a business. It is a for-profit business.
Right. It has to be.
It has to be. You don't have, this public utility concept like you would for an electrical grid or water infrastructure, or it just doesn't have the same, collective action principles, right? It follows more of the principles of an operating business.
Right. Exactly.
I'm learning that banks have a different valuation metric than P/E ratios. There's price to book, and for some reason banks don't have as good of metrics on price to where some fintech may have a great P/E ratio.
Right.
So banks are just kind of more conservative capital managers, and they're not going to lose as much money. Their stock price, is not going to go down by as much. But they may not have that explosive hockey stick growth potential that a startup would have.
If you see hockey stick in banking, it may be short term.
It's a problem.
It could be a real problem, just because banking's a very low margin business.
Yeah.
You're earning small percentages on your assets, and you have risk capital, and you have all these things in play, and so what you have to do is be right 99.9% of the time.
Yeah.
On everything.
Yeah.
And so you add to that what we have going on in the market, and we see it all the time. I think consumers and business owners see it all the time. You have fraud in huge scale right now that is a battle that banks are fighting. But, individuals and businesses, I think, that's another huge area for improvement and controls that we need in place because the technologies move so fast. The bad guys have too.
It's so true. I mean, I'm getting calls from people that have lost lots of money to some sophisticated fraud actors. Right. And I'm now thinking about okay, if banks are potentially, now let's just go through what the OCC said, and one day maybe the Fed will create language. Right. It's feasible that in the next, say before the end of this year, in the next 9 months, the Fed could follow suit.
Yeah, who knows how fast it could happen.
Who knows? I mean, we could be surprised. It could be tomorrow, it could be a year from now.
Right.
But let's kind of go through those things. Custodying stablecoin deposits,
right.
Custodying digital assets.
Right.
There was a third item on that list.
Stablecoins.
Yeah, stablecoin. I mean, issuing stablecoins even, which shocked me.
And then node service activities.
What was that one?
Acting as a node or a staking.
Oh, right. It could act as a node I don't know if too many banks will do that.
Yeah, I don't know that they would be prepared for that.
Yeah, and there's not really a lot of, just going back to the economics of it, there's not really a lot of benefit to acting as a node.
Right. Staking
maybe.
Right.
But I'm telling you, staking yields are low right now. I mean, they're lower than, I guess if you're yield farming and doing some of the crazy stuff, but if you're just doing regular ETH staking, it's pretty low.
Yeah, I think, if you look at the stablecoin market though, you've got
Tether and USDC,
Tether, which is like 50 billion.
Tether's up to 200 billion.
200 billion.
Yeah. USDC is probably around 50 billion.
Yeah. But I mean, the total market's huge.
Yeah. And
dollars that are already tied up there, and it's all non-bankers.
Right.
Handling that right now.
Right. And handling the stable coins, but then the depository for the majority of USDCs is BNY Mellon.
Yeah.
Because they got that non-objection letter.
That's right.
Now I'm wondering, does some of those deposits move around? It'd be kind of cool to encourage stablecoin issuers to say, hey, let's move those deposits around. Let's diversify. Those are non-sticky deposits, so we need to put them in as many banks as possible. Let's put them in some regional banks. And that's a good story for elected officials.
I think that's true.
As Senator Cruz is the new chairman of Senate Commerce Committee, he'd love to be able to say, hey, my Texas banks, my regional banks here in Texas, like Frost and Third Coast and Comerica and all these different, they're getting more deposits from stablecoin issuers who are seeing the benefits, like they want to drive that benefit to the community.
Right.
How better to do that than to put those deposits in a regional bank that's going to lend regionally instead of, BNY Mellon, which is going to lend globally.
Yeah, true. That's a good point.
That'd be a cool narrative to drive home, once that starts to happen.
Yeah.
So what do you think is next? Do you think, let me, before I get to what's next, we were talking about fraud.
Right.
And we were talking about the things that the OCC letter was talking about. If a bank were to custody digital assets.
Right.
I would imagine, just like there's all these ACH anti-fraud education training that everyone has to do as bankers, but also even their customers have to do some probably minuscule amount of that too, because they're the ones that are getting defrauded.
Right.
I would imagine that there's probably a huge learning curve for banks on crypto rails, like crypto custody,
yes,
multi-institutional custody, hot wallets versus cold wallets, and not only for them, but for their customers.
Right.
And the bank doesn't necessarily have to do this, but they may choose to say, hey, by the way, if you're being, if someone reaches out to you about an investment platform and, you've never heard of it before, but they seem really trustworthy, don't trust them, there's probably a lot of things that I think banks have that trust built up.
That's true.
Over many years with their customers. And I'm wondering if there's a place for banks to educate on some of this fraud that's happening in the crypto world that's even more, I'd say it's even more sophisticated than ACH fraud.
Right.
I mean, I could commit ACH fraud. I mean, I'm not going to, but it's something that's I could be capable of doing, because all you have to do is get different, wiring instructions and slip them different numbers. But committing like some fraud on the scale of like developing a entire front end for a crypto exchange that doesn't exist, and like trading and, you know, making someone think that they're making money and like sneaking a wallet address in there that siphons funds out.
Right.
That is something that less than 0.1% of the population can do.
And the evolution of computing, quantum computing, all these systems that are coming out.
Exactly.
And that's been the big concern, right?
Yeah.
So
I'm wondering if there's a place for banks to provide that education at some point.
And I think, if the market continues to evolve and grow into the banking market where you see that as a real partnership, you're going to see that for sure.
Yeah.
I think the security side of it is always on the forefront of the bank's minds, and something that we share is just part of our community involvement.
And the bank may not do it. They may outsource that, right, to like a trusted institutional grade, like white label it was what I mean. Like purchase, say, hey, this is the best of brand. This is the best of breed education for anti-fraud, and it comes from the best kind of ISAC, if you will.
Yeah, and I think you're looking at that exactly the right way.
And then you could white label it and Third Coast. This is the Third Coast training platform, because you don't want to reinvent the wheel. You don't want like 50 regional banks in Texas.
No, and I think that's exactly right. And I think everybody's going to be doing it the same way.
Yeah, I mean, we're real time coming up with an idea that I think has legs. Getting a bunch of the regional banks together and saying, hey, let's get best of class education, white label it for each bank. That way nobody's having to, reinvent the wheel.
And I think, to your point, the regulatory bodies have to understand it all too.
Yeah.
And so.
And that takes time.
Yeah, and the percentage of banks that have gotten actively involved in studying and learning about the industry is probably, I don't know, would you say even 5%?
I was going to ask you. I love putting arbitrary percentages on things that I only have a faint clue. Just like, 5% sounds right. Now, I would have said maybe 10%, but I would definitely have not said any higher than that, between 5 and 10%.
Yeah, I just think you've seen some banks that wanted to come out of the box and be experts in it and got involved real early.
Yeah.
And
then you have others that are involved quietly, and then still others that
have no idea.
Yeah. Probably the majority.
And you and I have had conversations with some folks and gotten that kind of input. So
right.
That's kind of where it is. Yeah.
Yeah, we've had some interesting non-interest.
Yeah.
Interesting non-interest.
Well, this whole, walk that we've taken together to a certain degree has really been educational for the most part and productive in terms of creating absolute, workable solutions.
Yeah.
Not so much, but it's been an industry that continues to evolve, and we keep seeing the growth and what's going on, throughout the industry of, new applications, new, ways to manage it, new ways to utilize it, new ways to, turn it into a financial tool. I mean, 4 years ago, would you have thought we'd have, ETFs and all this other stuff with,
right.
We can all invest in it, but we can't bank it, which is kind of interesting.
So correct me if I'm wrong, but I'm seeing two ways for banks to make money here. One is just traditional treasury management deposit services.
Right.
Two is collateral. So banks are very sophisticated lenders. That's the whole, not the whole business, but part of the, one of the main three legs of the stool.
Right.
So if you had Bitcoin as collateral, let's just use Bitcoin as an example for this. And you could say, all right, well, this commercial real estate, right now, commercial real estate is much better collateral than Bitcoin. Bitcoin's not even collateral yet.
Right.
I don't think, we just ended SAB 121, which made banks write those down as like, you had to essentially have dollars backing it. So
Basically,
it was the opposite of collateral.
You had to write it off.
You have to write it off. So that is literally the opposite of collateral.
So you go to real estate and, on an owner-occupied deal, you can leverage 80%, the market. So that's collateral value there.
Which is tremendous.
It's good. The number one is dollars. So
sure.
You can do 100% leverage
sure.
on dollars, 80% on real estate.
What's in between real estate and dollars? Bonds. Yeah.
Life insurance.
Yeah.
Other types could be inventory. It's going to be, 50% or less for banks that'll actually lend on inventory.
Yeah.
Accounts receivable, could be up to 80% depending on who your customers
sure.
are.
Credit worthiness of the customer.
Right, credit worthiness. But it kind of tiers down from there. And so you look at cryptocurrency right now, and that's just considered a volatile asset. And, the reason you can, go higher leverage on a dollar, you know what a dollar's worth, right?
Yeah.
And you just have to work, through those processes. And real estate values tend to change very slowly over a period of time. And so that's kind of the justification.
So imagine in a future world where you could leverage Bitcoin 95%, not because it's going to stay stable, but you can have governors and mechanisms to have collateral requirements that keep up with that LTV, I guess you would say.
Right.
So you can kind of, if the value of the collateral drops, then you have to top up the collateral essentially. Right. And that could happen like on a minute by minute basis, right? So say that is in place. So you have that collateral. It's always going to be relatively the same as the dollar value at which you underwrote the operation.
Right.
So imagine that doesn't exist now, but imagine that exists. And you're permitted to like lend 95% on that. The ability to repossess, like the perfectibility of that collateral from a technical perspective is second to none. Because with right now, again, it's worth zero in those arrangements. But if you could repossess it through just a multi-institutional key and you just had to tell the big Lloyds of London or whoever's holding that other key, like, hey, they defaulted, send me the Bitcoin.
Yeah.
And you know that the Bitcoin is going to be, they by a minute by minute basis have been topping it up if the value's falling, or they're able to take some out if the Bitcoin value rips up or something like that. So you know from a minute by minute basis, I'm going to get exactly that much Bitcoin if they default, and then 30 seconds later, the Bitcoin's in your hands. No cost. How much does it cost to repossess a commercial real estate? And you're getting 80% LTV on commercial real estate.
The only thing that we haven't taken out of the equation is volatility. Now, you're saying it's not volatile because would you have stable coins balancing everything else?
Well, so I'm saying you're essentially having them top up the collateral. So say if Bitcoin goes down 10%, they have to throw more collateral in there to make the Bitcoin in the deal be an equivalent dollar value to it. So it's always going to be $100,000 worth of Bitcoin. And if Bitcoin drops, they got to, and if they don't, you just take it. Right. I mean, if they don't, it's like a margin call essentially. Yep. So you keep the Bitcoin collateral at $100,000 no matter what, and that may be 1 Bitcoin, that may be 0.8 Bitcoin, it may be, but they're from a minute by minute basis,
so
they're having to
backing that.
You've got a backing,
the stable value.
So it's a stable it's $100,000 all the time, every minute of every day. And if this person doesn't meet that margin call, then you start liquidating, the asset. And if they default on the loan, then you liquidate the asset.
Right. I
think someday that's going to be more valuable than real estate as collateral. Call me crazy.
You may be right. I mean, I'm still a banker. I just,
Yeah. I don't know. Obviously, you're never going to, in the United States, you're never going to get better than the dollar.
Right. And the more comfortable approach, and we've started that with some instant payments and things like that, is using the stable coin.
Yeah.
And so
true.
And that transaction does exist in terms of, leveling the playing field. So I think, if you're in a stable coin and, your backing is, Bitcoin or whatever, and you have variations, you're going to have to top that off, right? You're going to have a margin agreement to back up your stable coins, right?
A margin agreement. That's what I need to call it. I try to explain it, but that's the best way. A margin agreement that keeps the collateral.
Right.
Yeah. Well, that's a ways off, but we can dream.
Yeah. Well, I think obviously that's where people are wanting to take it. And, the option is, you got to start slow and try to build up to it. And so I think, once we get the regulatory framework around things, then you start seeing, the innovation in how to utilize it from a financing tool and leveraging those assets a little better.
Yeah, and I think if we keep the same tax regime, that's going to be a powerful model because people don't want to sell their Bitcoin to do something. They may have millions of dollars worth of Bitcoin,
but they want to use it to buy a house or
But they don't want that taxable. They don't want that capital gains event.
Right, and that's a good point too.
And then they leverage it, get the cash to buy the house. They don't buy the house with the Bitcoin because that's a capital gains event.
Right.
But if you leverage it, just like I'm told, the 1% of the world doesn't really liquidate assets. They just borrow against their assets.
And that's true. And so let's just say you have an investment portfolio that you've acquired over a period of time that's, not in a 401k or any other kind of trust account.
Yeah.
That you can leverage that,
with
without
some
tax,
borrowing.
Liability. The annuities have a taxable event on them if you leverage them. So,
but just your brokerage account.
But your normal brokerage account or your real estate, your commercial real estate.
Yeah.
You can't really do it with your house in Texas, but commercial real estate, other assets you can, tax free.
Mm-hmm. Yeah, I think that's the. And now we did see Trump say something about changing the IRS tax treatment for crypto.
Yeah,
which I think would be huge. That'd be extremely world changing, because right now that's why you don't use it for everyday transactions.
Right.
Now, will Bitcoin? You probably don't want to use Bitcoin for everyday transactions either, because you're trying to accumulate more of it as the store of value.
Right.
But you might use some other, crypto asset like Ether, Solana, or something. Also with lower transaction fees, or you could use Bitcoin on the Lightning Network. But I digress. So I think that's unlikely. I think the de minimis exemption is possible.
Yeah.
So like you could buy your walking around crypto and be like, all right, I bought it here. My de minimis exemption, if it's like, trading in this window and I use it to buy stuff here and there. Now, I don't want to use crypto that I have the cost basis of like 1/100th of what it's worth now, because that doesn't fall within the de minimis exemption. So you have to start thinking about wallets. Like, all right, that wallet I'm going to hold. That's my long term.
Right.
Figure out a tax strategy with that later. But if I bought some today, I've got a pretty big threshold. Like foreign currencies, I think is it 200? What is it? $200 de minimis exemption, I think, for foreign forex. So if you're buying euros and the dollar strengthens relative to the euro, or I guess the euro strengthened relative to the dollar before you switched it back to dollars.
Yeah.
So you actually made money, but you were just traveling in Europe, right?
Right.
You have a de minimis exemption where you don't have to calculate a capital gains. But if you're a forex trader and you're making millions of dollars on these currency transactions, then you have that capital gains events.
Yeah.
So that I think could be possible. Eliminating capital gains on crypto, I don't think that's feasible.
Yeah.
What do you think?
I mean, I just don't think, the Fed is going to, take an asset that has that much value and impact on the dollar and not get something out of it.
I agree. I mean, it'd be like eliminating capital gains on real estate.
Right.
That's an exaggeration.
I mean, if you're going to make it part of the financial, system, then it's going to be treated like the financial system.
Yeah.
And taxed appropriately, I guess, or inappropriately.
Yeah, I think one thing I think the de minimis exemption is important, but eliminating capital gains, wow, that would be amazing. Now, there is an argument for certain commodities, like you don't have capital gains on certain commodities like wheat or oil. You don't have to pay those capital gains twice, right?
Right.
So sometimes Bitcoin miners have to pay it twice, both when they mine it, that sets their basis, and then you could also have that's a business income tax.
Right.
But then you also could have, like, say you sell it a month later and it's appreciated, you could have a capital, so you could get taxed on that twice.
Yeah.
That doesn't exist for oil.
But you get taxed only on the gain above what you already paid for.
Yeah, but then you've already been taxed on your business income for mining it. So that's kind of a minor, like a small issue, but the tax treatment is a fascinating conversation. Back to banks. What do you see moving forward? So I asked you this a second ago, but then I pulled the question back.
So I think what we're going to see is a process of the regulatory agencies deciding how they want to manage things, the kind of rules they want to have in place, and I think really we still need legislation to cover these bases, and so I think that's going to take
market
some time.
structure, stablecoin legislation. Yeah,
I think all those things are going to take some time. So I would say 24 months things start firming up, and I think we're going to probably have more good news coming out and positive expectations out of the market, assuming things hold steady and nothing crazy happens anytime soon. But I think it's just going to take a little while before the regulatory bodies are ready to administer kind of the expectations.
Yeah. Yeah, it always takes time, and we want it to take time because we don't want anybody going out there as a regulator to try to regulate something they don't understand yet.
Right.
That could lead to bad outcomes. Let me ask you about macro stuff.
Okay.
We're seeing some crazy things right now with interest rates. There's a lot of theories out there that Trump is daring Jerome Powell to blink on rate cuts. and he's purposefully creating these like market slowing events like tariffs and different things so that the markets slow down and the Fed is forced to cut rates. The motivation being like the U.S. government has to refinance a lot of debt soon. We have a lot of short-term debt that if it's refinanced at current rates, it could be a problem. Do you buy that theory? I'm kind of mixed on it. I don't know.
Well, I think you've seen, the Fed drop rates a couple times, thinking that would, stimulate activity, but the bond market went the opposite direction.
Yeah, that was
the
weird.
bond market tells you what the market expectation for inflation is.
Yeah.
And it's still high.
Yeah.
And so, some people are expecting rate drops, fairly soon, and the Fed can do, I guess whatever the Fed decides to do, but that doesn't necessarily drive market rates and international market rates.
Right.
And, the kind of pricing you're going to see overall. And I think it's going to come down to when we actually have some stability on the pricing increases that we've seen. And there are certain areas, obviously, that get hit worse than others. I mean, the cost of living is tough, with grocery prices and home prices and all these different things that are happening. And I think that's why, you're still seeing the bond markets up.
So let me ask you this. Is the Fed, it probably worries the Fed to think if we drop interest rates again, but the bond market goes the other direction, we're losing a little bit of our monetary control. I mean, do you think that they're waiting to drop rates until they feel like the market is in line with? Do you think they think that way?
I think that it is a quarterly assessment. And I think they have to see where trends are going and how far they can project out.
Yeah.
But I think when the Fed changes their pricing, it affects the banking market, and so then maybe theoretically, the bond market may still be high, but if the cost of borrowing goes down at banks, and maybe that provides some ease into the overall cost of business and doing business, then maybe there's some benefit there. I don't know how they're going to justify that. I mean, you got to watch what's going on with jobs. You got to watch what's going on with overall economic activity. And so, I mean, I think we'll see a lot after this first quarter to kind of see where results are.
I know. We got to get on record with our projection for how many rate cuts we're going to see this year. Are you allowed to project that as a banker? Are you allowed to estimate on that?
I mean, I think I can shoot from the hip.
Opine on it.
Yeah.
So I'll tell the audience what Polymarket and Kalshi, the betting markets, are saying. I looked this morning. They're pricing in. I think the highest likelihood is 3 rate cuts this year.
Okay.
Now, a couple weeks ago, the likelihood was on 2 rate cuts, and so I remember this figure: 7%. There's 7% betting odds that there could be up to 5 rate cuts this year. But there's also like 7% odds that there's 0 more rate cuts. So there's that bell curve, right? And you have 0 rate cuts up to 5 rate cuts, and then kind of in the middle is like 2 to 3.
Yeah.
So but a couple weeks ago the market was pretty sure on 2, and now the market is leaning a little bit more towards 3.
Well, what are they saying on rate increases?
That's what I'm saying. The number of rate increases would be 3. Sorry,
You're talking about
25
drops.
bips.
Yeah.
Rate increases. There was like a 1% chance of a rate increase. It was super low. It was like, I think it was less than 1%.
Yeah.
And I think each of these would be a 25 bip cut.
And that's typical.
Projected. Yeah. So, I mean, if we saw, I guess my question is, do you think that those betting markets have been proved right more times than I can count in the last couple of months? But, there is sort of also this what you're talking about is if the Fed does cut rates, and on some of those times that they cut rates, the bond markets go the other direction and project inflation, or they're fearful of inflation, so bond rates are blown out the other way. That's a kind of a scary scenario for a Fed governor, I'd imagine.
Yeah, I agree with that. And I think, there's a lot of unknowns right now is the problem. I think the sentiment that I see right now is probably maybe rates hold steady, that maybe there's a higher, chance of a potential rate increase than a drop right now.
Really?
And again, every economist is 50-50,
Sure.
50% chance they could be right. But I mean, just the direction we're seeing right now, we see that there could be a rate increase, I think.
Wow. That'd be interesting. A rate increase. Trump would be furious.
He wouldn't be happy about it. But I mean, and there's also a very good chance that it could just stay stable for the rest of the year.
Right.
Because there's maybe not enough to drop rates.
That's I would probably be on the lower end of like maybe a 25 basis points cut, maybe once, twice.
Yeah.
Or it wouldn't surprise me if rates stayed stable.
Yeah.
I guess what I'm
Yeah. And if I was guessing, I'd probably say stable.
stable. I'd be between 25 basis points and 50 basis points over the course of the year. But it's always fascinating to me. I don't know. You watch this more than I do, but like the demand for for these tranches of U.S. debt.
Yeah.
And if the demand is slack, what that does to, they have to raise the yield to capture more demand.
Right.
And it always worries me, like, it's the most liquid market in the world. So, you could raise it by a basis point and you have a flood of new capital. It's not like Bitcoin where like it's a pretty thinly traded market at $1 trillion market, $2 trillion market cap. This is the largest financial market in the world. So the liquidity's there, but it does make me worried, like black swan events, like, man, if they can't,
Well, the market wants more yield too. I mean, the market's looking for the yield.
Yeah. So they may hold out for
I'm seeing that.
higher bond rates.
And we've kind of moved out of a market where cap rates and everything were so low when your interest rates were at 3.25% the whole time.
Mm-hmm.
Now you've got potentially some challenges on the real estate front because rates have gone up.
When you say cap rates are going up, describe that to me.
So the expected return on certain investment types,
Okay.
has gone up. So, say a AAA investment was 3.25%, 2 years ago.
Annual.
Yeah. Now it's probably 6.5%.
Okay.
Maybe, somewhere in that ballpark. High fives. It just depends on the product type. But
Okay.
the more high risk assets, the cap rates went from 6. They're now 8,
10.
9, 10.
Okay. And is that always? I mean, the treasury yields, it's always going to be slightly above treasury. So AAA cap rates are going to be what, a percentage points higher than treasury bonds?
I mean, maybe in the same ballpark.
Okay.
For the really good stuff.
Okay.
And maybe it's shorter term. Maybe it's more, more upside for you, from an investment standpoint.
Okay.
So you're getting that kind of return. But, the treasury market's obviously stable and,
Mm-hmm.
Theoretically zero losses and all that good stuff.
Right. So you're seeing the expectation for those cap rates to keep on. So people are kind of holding cash in expectation.
I just don't think cap rates are diving right now. And I think if they were, going super low or lowering in across the market, that you would see, maybe a trend towards lower rates.
Yeah.
I'm just not seeing a lot of that right now.
And that's probably one of the reasons, including the tariff talk and all this other stuff, that we see like risk assets like Bitcoin struggling the last couple of weeks.
Yeah. I think that's probably a good correlation.
Yeah, because if you can make, 6% on a zero loss, or
Right.
there's the alternatives are
Guaranteed deal.
there. Yeah, on
Yeah.
guaranteed deals. Okay, that's fascinating. We're diving off into a segment of the market that you're educating me on, but let's take it back to banks.
Okay.
Closing it out, the American banking system is kind of one of the most envied in the world. More than 5,000 or so U.S. banks, 5,000 plus.
Yeah. I think about 4,800.
4,800. Okay. As our, we have the premier global reserve currency. We have the premier payment rails. I mean, we haven't had necessity breeds invention, and we haven't had necessity because we have really, really good rails.
Right.
We have the dollar. We have, credit cards. We have ACH. We have FedNow. We have all this stuff.
Right.
We see crypto taking off in developing economies that don't have those exorbitant privileges.
Right.
What do you think it's going to take to get a stable coin in every person's, like banking app? Or how are we going to get to a point where in the United States, and maybe this is 30 years from now, 90% of people have some exposure to digital assets, whether that's through stable coins or actual crypto.
Yeah.
Is it, partly through their bank, partly it's, like the OGs did it in Trezors and ledgers and hardware wallets, but not all of America is going to do that. How do we get there? It's obviously happening in Vietnam, Nigeria, all these developing economies very quickly out of necessity.
Right.
But we just don't have that necessity.
Yeah. I think, in our markets and what we see all the time is new investment opportunities get turned into some kind of platform.
Okay.
And whether it becomes part of a 401k plan or, just another cash investment opportunity, if you've got a stable coin option at, a number of, banks in the world that are pricing, in a manner that is competitive with money market rates or CDs or something like that, and it's considered a safe investment, you'll see it, grow, I think, from there.
Yeah, I've always wondered about that. Like I said, that was the last question, but I have another one. Where are, the stablecoin issuers right now are taking most of that alpha,
Yeah.
right, on the yield.
Yep.
When will they start giving that back to the customer? Or, you know what I mean? Like the bank, BNY Mellon in this scenario, let's say Circle scenario,
Right.
is probably getting some sort of, they're getting those deposits.
Right.
Circle is getting the yield, treasury yield.
Right.
The owner of the stablecoin is getting nothing. I guess they could go and stake it and, do some different things with it, but then you're not. That's not a stablecoin anymore. You're swapping that into other assets and you're getting more risk in those assets as every swap you go out into the market further away from like ETH and stablecoins, you're getting higher risk.
Yeah, and I think it's just a usage fee, that's going to be, it's got to be split with the holder. So
Yeah.
if you own it. Like
so do you think
CD,
Circle and Tether will one day like kick a little bit of that back to the?
Yeah, you would think, but I guess, from a treasury standpoint, their source of funding and where they're getting their dollars and how they're managing that, obviously they kind of control the market and and can drive the end users, I guess, to put the funds there because that's where it's coming from.
I wonder if there's something there for banks. It's like if the Fed copies the OCC at some point, and if a bank could issue a stable coin, could they see a flood of deposits? And if they just shared 1% of that yield with the customer, and they kept the other 3%?
I think that's kind of the way you manage the deposit balance sheet anyway, and so you're really talking about cash deposits and offsetting the stable coins. It's all about the treasury, right?
But so this leads to another question. Bank of America is paying 0% on their deposits.
Right.
But some regional banks are paying up to 3%, right? Or
Right.
maybe.
And I think that's the difference you'll see.
Huh.
So if there's a competition for those dollars, that's when it starts driving the return
Okay.
to the customer.
And do you think that there's a play to be had there with regional banks? Again, not today, but in years to come, being that, kind of managing those deposits?
I would just say that I think any bank in this country is going to want to participate in a flow of funds and something that drives legal deposit growth.
Yeah.
And so I think that's just going to be a natural evolution to see in the future. I think that's coming.
So say, total stablecoin market cap is like around 250 billion. What does it need to get to before like every bank CEO in the world, in the United States, of all 4,800 U.S. banks is like, holy smokes, we need to get into. Does it need to be $1 trillion in stablecoin? Obviously Bitcoin is just under 2 trillion in market cap, but stablecoins have not. They could one day be that. Right. But what do you think it needs to get to before every bank CEO is like, this is a massive
That's
opportunity?
a hard question, because you just really don't know what the market size is going to grow to. What the demand factors are going to be, and so it's hard to say. But you would think if you're going to need to have a stable coin to back those transactions on a volatile asset, then it should be something equivalent to whatever the market is. And I think at the end of the day, you end up seeing the dollar backing all the transactions, and of course, we want the dollar to be the currency that you do business in. But I don't know if you've looked at it that way, but if you're talking about stable coins and making the market stable, then dollar for dollar for every asset that you have in the market.
Yeah, and obviously we're already at 250, the 15th largest. Stablecoins are the 15th largest buyer of U.S. debt.
Yeah.
Based on like countries. So stablecoins buy more treasuries than Saudi Arabia.
Yeah.
But if you get to $1 trillion, you're like the fourth largest buyer of U.S. debt.
Yeah.
Up there with like Germany and Japan.
Yeah.
I feel like maybe it would take something like that, and I don't know. I'd say maybe a doubling or tripling of stablecoin market cap before every bank CEO in the United States is like, we can't allow BNY Mellon to have all those deposits.
I think that's a great point, but I also think the fact that now we see the regulatory agencies coming out with some guidance that, hey, we see a path in this particular area is going to change perhaps some of the approaches taken.
Would it be more attractive to just custody the dollar deposits from a stablecoin issuer, or to actually issue a stablecoin?
I mean, I think the simple path would be just
the former. Yeah.
I mean, it's just a simpler path and more straightforward, and so managing the rest of the intricacies around that, is something that I would see developing in the future.
Yeah, I think there's probably a big difference. I would love to know what BNY Mellon is making on those deposits. I don't know if that's public or not. I've tried to find it, but
it's not in their annual report.
I should get ChatGPT to scan that for me to see like what are they making on that, and what's the difference between like if BNY Mellon were issuing it, they would be making all of the yield,
right?
But they have all of the risk, all the overhead.
Right.
Like you said, all the engineers,
yeah.
all the capital that you'd have to spend to do that. It's probably tremendous. And they said, hey, we're not good at that. We're good at custody. So we'll be the qualified custodian for all these assets.
And what do you see in the expense, that is reported by Circle or whomever on managing that process?
That's a good question.
I'm not sure if that's been.
I don't think that's public.
Yeah.
Because Circle's private, privately held. I wonder if there's a way to get at that. I don't know. It'd be amazing to see Circle go public, so we had some SEC data on this.
Well, I think they're talking about that now.
Yeah.
I mean, you've got them and who was it, Kraken?
Mm-hmm.
Yeah.
Gemini and Kraken.
Yep, Kraken. Yep.
Talking about going public. This will be a good year for it. I mean, from a regulatory standpoint, maybe not from like a market timing standpoint. I mean, who knows what's going to happen later in the year? The March has not been a good month for digital assets.
Well, and what did Trump say? It's going to be bumpy.
He did. He said it's going to be bumpy.
We'll see. I mean, obviously there's just a lot of different activity going on right now that, people are scratching their heads and just don't really know which way things are going to go yet.
Yeah, I know. It's a fragile thing, global economies.
Yes.
You don't quite know how far you can bend them till they break.
Yeah. Well, and I think they're getting bent in different directions now.
Yeah, true.
So we'll see.
Fascinating times. JK, we went longer than we intended to, but I think the conversation was enlightening for me. I hope it was for our listeners as well. No. And, let's schedule another. Let's pencil another one in a couple months, and we'll see. Maybe some other drastic announcement has come out by then. And
yeah, it'll be interesting to follow up and see.
It's almost like every time we get one of these big announcements, we need to have you on just to follow up.
Sounds good. Yeah, we'll watch together.
All right, sir.
All right. Thanks so much.
Hey, it's Amy. Click over here to subscribe. Click over here for more content, and we'll see you next time.